Welcome to another episode of Blockrevision, and in today's topic I will present you a bunch of chart statistics from previous months that cast a shadow on a current situation and economic background. So it will be very interesting in terms of understanding where we are right now in terms of economics ratings and different conditions. So let's begin. So let's talk about this correction on S&P 500. Why we really have led to this. So everything stems from United States inflation rate that right now is leveling the ratings from early 80s, where we just have gone through an extended period of time of a inflationary crisis, where we have quite of an difficulties in tackling such conditions, and we exactly repeating the scenario from early 80s, and right now trying to recover, but as Fed said, it might be painful at first. So to inflationary conditions add up the problem with employment, as we can find that number of job openings is increasing, but also following this there is number of voluntary quits that also is rising. So we are suffering from not enough people in the economy that are able to take the necessary job, and it means that wages need to rise in order to tempt and attract more and more voluntary workers. So right now we can find that this also adds some oil to the fuel, where we can find that inflationary spiral is surging. In order to tackle this, however, we have switched on higher rates that finally came to fruition, where we've seen first hike of interest rates in March, and right afterwards we can find that there are more of higher rates coming. Right now the projection is that this liftoff may persist by 2023 and even by 2024. So is it, however, the final way to tackle these problems, especially with even reverse repo charted right now at sky high positions? So there are many questions that need to be answered. Right now, as you can find, that size of Fed's balance sheet is more than a third of the size of US GDP, and regarding what happened during the financial crisis right back in 2008, this scale of printing is really unprecedented. So right now we expect a few more interest rate hikes this year. There's expected to, in recap, there will be around 7 or more hikes. So it's quite of an aggressive reaction to this inflation. However, it exactly is trying to recover the very poor situations of US and also citizens that are really relying on what the US financial policy is. So right here we have found that not only S&P 500 is going downturn, but also USD IG bonds index that was chart that's been made at the end of April, where the situation was a bit tougher, but right now we are trying to recover from this scenario and revert a bit this yellow bar. However, in looking in the mirror, at the rear mirror, we can find that there were no many times like this where not only S&P but also IG bonds index has brought so low returns. The recent similar period of time was back in 2018, but the lower scale, and also in 2008 during this great financial crisis. So that's very tough conditions when looking at the current situation for investors to really go through. Right now we can find that in April, reserves at the Fed recorded the biggest weekly drop on record, so it means that we are right now eventually going through a difficult time where this liquidity will be grabbed off the table. So we can observe also that there are different asset classes that may suffer during this time. However, I would like to debunk the myth that DXY should rise infinitely during the times of hiking cycle. There was just one that long period of time where DXY has surged throughout a very long time. There was 84 cycle during this very tough conditions of inflation that has spiked twice. So would we follow this situation? I would rather find that finally, after this really unfavorable conditions, we may eventually go downturn and follow one of these paths. However, it's still everything intact. So real assets during interest rate hiking cycles showing that there are different paths. It may go during this turbulent periods, and normally gold is a good solution. However, during this time right now, it will be more difficult to say how the gold will perform, as we have also Ukraine-Russia crisis on the way that may appoint with this solution to come to fruition of bringing a peace, possibly that gold will eventually have a sell-off, as it has risen when that invasion has commenced. So the one thing that should stay that high might be industrial commodities that may have it's also quite often robust period. That's exactly especially industrial commodities should have it's a very good time, but I wouldn't say so about S&P and also DXY. So I would stay by industrial commodities, at least as we are observing that this interest rate hike may even get us back with Fed securities held to the levels of pre-pandemic. So there is a long way to go down. It's quite of a ride ahead. So this liquidity might be taken off with these restrictions to be eased, and eventually let's have a look at another period. That's another projections that and that is also intact. So in 2022, on the halfway, we should observe something like liquidity grab, and eventually that will lead to liquidity or quantitative tightening. So it doesn't mean literally that we should be afraid. We can find that very often tightening is going without turmoil, unless that's something wrong with earnings of companies is. So just merely the tightening isn't the reason of causing any recession. So right now we can observe that during this tightening, S&P 500 has performed most often good. The one only worse period was back in early 70s during this long-lasting crisis. So I should find this as an optimistic and also green light to everyone that want to invest during such a turmoil we are going through right now. So after this quite of a bumpy ride that we are going through right now, after this correction on S&P 500, I should still find that we are in a scenario of very high likelihood of growing S&P 500. So we shouldn't really observe that very anxious scenario by Jeremy Grantham that expected that benchmark stocks will drop for almost 50%. It's rather off the chart right now, as we can observe that retail flows that started investing in January 2020 right now is getting back to the where they have started. So it means we really has liquidate those gains, and right now may finally start the growth from the points where this market noise is cleared out. So right now we can observe that after this very positive period, retail investors shown signs of fatigue after this trading frenzy. Right now we can find that eventually we are taking off those amateurs that has just jumped on different types of stocks in order to get a quick backs. So right now there is a maybe a little bit more tough time, but it will be more calm and also more predictable for us investors. So in order to justify that we have still a very good time ahead, possibly, is that there is 2023 being a year of midterm election, one that may appoint that after this intra-year decline that we have really gone through in recent cycles, right afterwards we do expect that return in 2023 should be satisfactory and highly positive. So recently we've seen also that this global equity funds has gathered a lot of traction from investors, retail investors, and it may have its quite of a roller coaster ride down from here. However, by 2023 we should eventually observe kind of a rebounds, and maybe even during this year there might be still a quite of a robust period of investments. So in terms of S&P 500 sector median performance after recession start and dates, we can find that right now, as we are before the possible recession, so considering we are right now after recession started, I would have my eyes turned on consumer staples, materials, healthcare, and also a bit on utilities sectors. So these are the possible winners during this tough time. However, we still not maybe surely in a recession period, but there are some symptoms that may point that. So just to be on the right side of a coin, and I would rather watch, especially in terms of longer term investments, to those sectors. Right now, after this 20% correction, we can find that we are equalizing the situation, and that has occurred quadruple in the past since economic crisis. So I would find that we should recover from here. So we have just reached a 20% correction, and there is a high chance that Nasdaq 100 breadth will finally jump up from here, as it already did, at least in some extent. However, Nasdaq 100 index P to E ratio is right now near its long-term average. That also is an attracting level. Right now we are jumping to crypto outlook, and I would like to have a look at what's going on with this sector. So in terms of Bitcoin price, we are just going through downturn, as we have just hit a level of this one standard deviation from this average line on NVT ratio, and we are just approaching 200-week average. But doesn't mean really that we are right now in a bear market. There might be some symptoms, but I would rather confirm that if we just approach a bit closer to a 200-week average, and maybe even test it from a down side. But right now, in terms of NVT, we are just jumping up to the levels of an mean average. That means that network valuation is right now at quite fair levels. So in terms of the scenario where we are right now, we can find that this kind of a pessimism on the market may be recovered by those guys that are really supporting the network at most. So Jack Dorsey has resigned from Square in order to focus literally on a Bitcoin mining system, and it should support it in the coming months and even years with some ideas. So Jack Dorsey said they want to make mining more distributed and efficient in every way, from buying to setup, maintenance, and to mining. So that's one of the things. And also this same guy is announcing Bitcoin Legal Defense Fund that should support developers. So these are the people that should support this sector on the way, especially with these ETFs that should eventually be pushed through, but right now been rejected. There are still some of the milestones that need to be accomplished in order to push the price of Bitcoin forward. So especially with those people from ECB and also Fed that say that crypto, in their opinion, are worth nothing and also should be regulated, especially with this laundering accuses that also sometimes been delivered by different environments. Alright, so right now crypto is the one thing that has its kind of a dark clouds above it, but should get away from this tough time. But even if something happens to this sector, cryptocurrency holdings account for a small fraction of the level and change in household net worth. So it means it shouldn't really, any kind of an local crisis shouldn't really develop to any single major crisis that may lead to kind of a slowdown of GDP growth or something alike. Alright, and right now let's have a look at market movers section, and I'd like to just point at NBS manufacturing PMI from China from Monday that I have missed that one, and the forecast was at 48.9 with a previous gauge being as low as 47, and it has crossed and entered a negative territory. Right now the actual one has turned out to be at nearly 50 points. That was a quite of a positive surprise for economists. So that means that we are recovering in terms of PMI, and it means that maybe quite of a easier times for China economy, even with this kind of a doom and gloom times being forecasted before. So this is Chinese indicator on Wednesday. However, on Tuesday as well, we had manufacturing PMI Caixin, and it also has equalized a 48.1 that also is getting better than it was in April. On Wednesday, however, we had important data from EA, and unemployment rate has shown that 6.8% is something that has been forecasted and also has been finally been noted. So there are no economic surprises on Wednesday. However, BOC interest rate decision was also as forecasted at 1.5%. Tomorrow we have ADP employment change that is the most important event for that day. In terms of trade idea, however, I would like to have a look once again at DXY, that is a dollar currency index, and we are right now being informed that there was a high likelihood of double test of that area that recently been set as a support that haven't been tested from a downside. So there was a high likelihood of return the price back to this level. So we have tested this support, and that support previously also been tested this right here. So we have claimed every single area that may become a possible rebound right here. The only one chance is back to test this area, but I would observe rather to have that DXY have its reversal right around this area and strictly follow another checkpoint that is at 100.98. So after this double tests from with different levels, I would like to observe that DXY should follow downturn. So DXY in the long term as quite unidentified. However, in medium term is going downturn after this quite kind of euphoria, and also in short term is going downturn to the most likelihood is that we will test this area once again of around low hundreds or 99, even 99 points on index. So in terms of possible area of a trade, there is exactly the one that I would like to just point, and this one sorry, not as it's short interest, so there's a high likelihood of this trade to succeed. So I do find a high chance of US dollar currency index to revert right around this area. Maybe I will extend it just for the safety reasons, and to not be stopped out. So there is a high chance with a risk-reward ratio 4.09 that this trade is will succeed eventually. So right, so that's it in today's video. Thank you very much for watching. If you have any questions, put it in the comment section below the video, and if you enjoyed, just put that like button below the video. Thank you very much, and see you tomorrow.